And alpha today is coming from avoiding losers. You can't, to generate alpha, those days are over of trying to pick the winning home run. It's completely gone. The forward momentum of the S&P 500 now makes it almost impossible to beat that benchmark. You can always talk yourself into a crash. Humans love to tell stories about everything. And one of the big things they tell stories about is the market. 71% of the time over the past 20 years, low H factor stocks, the good ones, outperform the high H factor stocks, the bad ones, right? The key is to lose less.
Julian, thank you for joining us on Capital and Power. I want to jump right in because people are always thinking about how do I make money? And one of the ways you suggest people consider to investing properly is to avoid the losers. And you actually have a formula, the H factor, that we're going to talk about. But right now, you have a contrarian opinion. You're saying that, quote, we're not seeing what everyone's talking about, which is an overvalued market. Why do you think that the market's not overvalued?
Well, in order for something to be overvalued, one has to consider what overvaluing actually means. And to us, when someone says something's overvalued, what they're really saying is any company, let's say within the S&P 500, is going to have a problem delivering the growth indicated by its stock price. Something's not overvalued if a company can deliver the growth indicated by its stock price. And to us, that is the most fundamental question. Can the company deliver the growth indicated by its stock price? And what you see is when you measure that across the entire S&P 500, there's only a 33, the median H factor or probability that they won't deliver the growth is around 33%. That means there's around a 67% chance through all the companies in the S&P 500 that they can deliver that growth. Now, how that is done is we look to the extent, first thing we want to know is what is the implied growth rate? What does the stock price tell us about what the growth rate has to be to support that stock price? Once we've got that, you measure that against what they've done in the past. So the fact of the matter is what it looks like to us when you do the math is not only are these companies have a relatively easy way of being able to deliver that growth, but they've been delivering it in the growth. So why would one assume now that suddenly the market's overvalued?
Let me interrupt. We're going to jump into, I want you to explain to us the H factor and what you mean by actuarial science to systematically remove overpriced stocks. But your bottom line hypothesis is that the market right now, S&P 500, is not overvalued. I mean, we have Jeremy Grantham saying, get ready for a crash. We have lots of pontificators saying too expensive. And you're saying the opposite.
You can always talk yourself into a crash. Humans love to tell stories about everything. And one of the big things they tell stories about is the market. But when you use mathematics and you use odds and probabilities, it doesn't show up that way. It, in fact, shows something actually very differently.
So let's talk about the H factor and how you use it as part of your investment strategy. And then I want to promise people, you've given us some losers that people might want to consider avoiding, stocks to avoid. Here's a tease. Target. This is my favorite store, is Target. But we'll talk about that in a second. But tell me, what, in simple terms, because I am not a mathematician, what is the H factor and what is it measuring for?
So first, let's consider what a loser is. When do you lose money? You lose money when a stock is overpriced or overvalued, right? But what causes overpricing or a stock to be overvalued? It's not the balance sheet and income statement. It's not the fundamentals. It's humans. And how do they do that? Well, humans, there's two forms of information out there. There's things that are known about a stock. The financial statements and the stock price are absolutely known. What's not known is the thing that I call vague and ambiguous information, things like news, right? The problem is humans take that news and they interpolate that and they impound it into stock prices. And that has an effect on the company, because if a stock price goes up, all it's saying at that point is the company has to deliver more now to support the price of that stock. And so the more vague and ambiguous information you find that finds its way into stock prices, the more likely the stock is going to be overpriced. If you think about it from an actuarial perspective, right? Actuaries don't underwrite risk based on vague and ambiguous information. They don't ask you, are you going to quit smoking? Are you going to go to the gym? No, they underwrite risk based on what they know about you. And when it comes to stocks, there's only two things known. That is the stock price and the financial statement. And we use that to calculate the H factor. It stands for human factor.
Okay. So the human factor, what is there a metric? Is it, you're using this, what's it, how successful is it? Help me understand how it does work. I read in the notes that we got regarding you that you've only gone to all cash once, and that was right before the great financial crisis. So what is its performance, the H factor?
The way you think of, so it's a probability. It's a mathematical probability. It's a percentage and is rated from 0 to 99. Basically, that's how it works. The higher the H factor, the more you want to avoid that company, because it means there's a lot of vague and ambiguous information in that stock price. We're not saying that it maybe won't perform. We don't know. With probability, you don't know. But what we do know is that 71% of the time over the past 20 years, low H factor stocks, the good ones, outperform the high H factor stocks, the bad ones, right? So if you're looking at investing using odds or probabilities, that's what you want to know. It doesn't work all the time. The key is to lose less. It's not trying to win more, right? The problem with portfolios is not that you don't have enough winners. It's that you have too many losers. And alpha today is coming from avoiding losers. You can't, to generate alpha, those days are over of trying to pick the winning home run. It's completely gone. The forward momentum of the S&P 500 now makes it almost impossible to beat that benchmark. The only thing left, and what we believe is left, is avoid losers.
Well, let's talk about some of the stocks that might be, I'm going to use the words winners or losers. Let's start with losers. Target, I brought them up earlier. 90% chance of failing to deliver on earnings. How did you come to this determination?
All right. Well, I'm going to look away for a moment because they're going to look at my screen because don't know all these stocks offhand, right? It's trading at $135 a share. It's around about there, right? The indicated growth rate, what they have to grow by on an annual basis, is somewhere around 1.3% annually, right? Now, that's telling us what that stock price implies. Now, what have they done in the past? If I look back of the past 12 quarters, they've actually had a negative growth rate of negative 1.3%. So not only do they have to achieve a 1.3% growth rate, but they've had a negative 1.3% growth rate on a mean basis over the past 12 quarters. The probability of delivering now positively on that is around 90% chance that they're going to fail to do that. They haven't done it in the past 12 quarters. 12 quarters has been negative growth rate. So why would we expect now that suddenly they're going to turn that ship around? And maybe they will. You know, I'm not saying they're not. That's the whole thing about how probabilities work. It's not, when somebody says to me, is that good or bad? I don't say to them, well, is it under or overvalued? The answer is, look for better odds, right? That's all it is. It's a coin toss, right? You can go 10 times of the coin toss and be wrong, right? It's all about the odds, the probability. Do you want better odds? That's it.
So let's talk about some other stocks. Among the quote, high H factor stocks, Kimberly-Clark, 98% chance of failure. Dow, 98% chance of failure. How would you gauge Tesla? 47% probability that it will fail to deliver.
Right. I'm just looking it up right now. Same thing, right? So Tesla right now, if you look at the stock price is trading around $407 or so. The indicated growth rate is around 3.3%. What growth rate could they deliver? Right? If I look back over the past 12 quarters, it's around 4.3%. So the mean historical growth rate over the past 12 quarters is pretty much commensurate with what they need to deliver. So the probability is around 50-50, 47.9% chance of delivering. Now, the question I always get asked is, was that good or bad? Should I own it or not? Again, look for better odds, right? It's all about the odds, right? In fact, we buy stocks without looking at names. We don't need to look at the name. We need to know the math behind the name. And that's not something that's been done before or something that, has been adopted, but we believe strongly in the math.
And then one of the stocks that you would believe in would be Google or Alphabet, a 1.8% chance. Its H factor is 1.8% chance of failure.
Yeah, correct. So again, now, so looking at a good stock, right? So, you look at Google, right? It's trading at $357. The indicated growth rate is 10.4%. The growth rate over the past 12 quarters has been 17%. So beating the indicated growth rate. Therefore, probability of failure today about 1.8%. But again, there's still a 1.8% chance they can fail. One thing I will tell you about the H factor, it's not good at picking individual names. The H factor is good at building portfolios, right? If you build a diversified portfolio of 25 names with the lowest H factor, what we've seen is that 71% of the time, the low H factor beats the high. That's how it works.
Well, that's what I wanted to ask you is your portfolio, because you use the H factor at New Age Alpha. So what is your firm's portfolio rating? I mean, how are you performing year to date?
Well, we own a combination of funds, anywhere from 4-star, 5-star funds. And again, they all use this H factor. It's very simple. So, for instance, our large cap core fund is the S&P 500, where we essentially remove somewhere around 350 names and have a very concentrated portfolio of low H factor scores. That's how we build a portfolio, right? There's nothing else to it. It's just removing those names. We have something called the allocation fund. Now, the allocation fund takes that large cap core fund and uses it to modulate market risk, right? We saw what happened in 2008. There's been, since 2007, 2008, there's been about 40 different events that have happened where there's been, of course, a downturn in the market, and you see the S&P 500 quite significantly drop. Now, what we do is we look at 4 different measures before we react. We can be 80-20, so we can be 80% equities, 20% fixed income, 60-40, or cash. And that's when you referenced earlier that in 2007, 2008, we were cash. Now, we can be any of those 3 things, and we use 4 signals. The LEI, leading economic indicators, and market momentum of the S&P 500, and the VIX, and the last one is a Fed decision. Based on those 4 factors, we will rebalance our portfolio. Now, what's important by those measures is not just the measure themselves. It's the order in which the measures trigger that allow us to manage the risk differently. So, for instance, if you see the VIX figuring down, reacting, or you see market momentum reacting, typically that is behavior that's happening. It's the very thing we want to avoid. And often followed by those drops is a V-shaped recovery. But that is not so when it comes to the LEI. If you see the LEI drop, and that is followed by market momentum, which it typically is, right? The market will react to that LEI changing. And then the VIX will drop after that. The VIX will start because the drawdown starts. And then the last thing is the Fed comes in to clean it all up. Now, based on those 4 triggering in that order, one has to be careful, and one would argue you should take your portfolio to cash, which we did, right? In all other 40 market events, we never went to cash. In fact, we stayed almost fully invested in the market and outperformed the S&P 500 in all 40 events.
So let me wrap up with a question I think a lot of our clients would want to know. You rate roughly 4,000 plus stocks with the H factor. Do you make that public, or do you have to be a client?
So we rate not only multiple thousands of stocks, we also multiple thousands of ETFs and mutual funds. We rate them the same way. The answer is, if you're an investment advisor, we give away what's called our space platform or our H-factor system for free. It is not something we charge for. We give it as part of the education where you can look up these H-factor scores for all these stocks going back to the year 2000.
When you think about risk, what risk are we talking about, right? We know the trust risk factors, the things like the Farmer French manage, right? Beta, there's high beta stocks, you should get a higher return, right? And then you've got your idiosyncratic risk. And for that, we know we've been taught at school is that one should diversify a portfolio to manage idiosyncratic risk. The risk coming from humans is an idiosyncratic risk, but you cannot diversify it away. You can only avoid it. And it's an unpriced stock. It's a risk that investors are taking that they're not getting rewarded for taking. That's what the X factor is measuring.